And remember where we talked last day, we talk about the cost of right? We identified the cost structure. Right. So we identified the cost structure, right? Short run cost, long run cost. Last day, right? I can remember. Now then, that is one aspect of the when you talk about the area of the work, like cost. Now we talk about the production and the cost, right? So we know that there is a relationship between the cost and the production, right? So all these cost functions related with output, right? What it has cost depends on the output function of output, right? Right. I mean, identify the cost, right? Now we are going to talk about the real revenue, like if we have that, right? First, I can explain the first being like revenue. Now, simply the revenue. So that is the how much firms earn, right? By selling particular product, right? So that is the earnings, right? Total earnings per period of time, right? By selling the goods and services, right? So that is call it as product, right? Only the goods and services, we call it as product, right? That is the revenue, right? So simply we take how we calculate the revenue. That is price into quantity. So here U means, what does it mean? U means that depends on market demand. That is the demand, right? What we need the demand, right? Depending on the demand in the market, right? Now, for an example, if the function is single product, right? 20 rupees per unit, right? The market demand or the sale of the product is 2,000, right? Then the total revenue is 20,000, right? So like that means the price into quantity, right? This Q means the total demand. That is the demand, right? P is the price of the product, revenue price, right? So that is the total revenue, right? So when the price, sometimes depending on the enter of the firm in the market, right? Price may change, right? Sometimes in some markets, price is determined by the market. So in competitive market, if you take the perfectly competitive, that is called perfectly competitive market. Why we say perfectly, price is determined, typically the price based on the demand and supply force in the market. Is there a large number of firms operating in the market? No? Single firm cannot influence the price, because it's too small. Right? They are insignificant, right? The market. They don't have any control over the price, right? That's why we say perfectly competitive market, right? There are a large number of firms. We take one single firm, still is small in the market, so they cannot influence on the price, right? Or the quantity, like that. So they have no influencing power, right? Right? So in that case, price is fixed, right? So here the DR pricing quantity, that price is fixed, constant. So depending on that, the demand, based on the demand, total revenue may vary, right? So when you take that form, right? The price is the quantity. The price is fixed, right? Quantity may vary, right? The value is the total revenue, right? Actually, price of right? Depending on the quantity. So the total revenue is become linear, right? The price is fixed. But in other case, the price is varying, right? In some markets, we call it as imperfect market, right? Now we can identify the two markets basically, perfect market, imperfect market. Perfect market means competitive market. Imperfect means there's no such a competition. Firms has some control over the market, the price of the company. Right? That's the imperfect. In such a market situation, what happens? So they can influence the price. Right? They can fix the price. If you take the monopoly, right? So the monopoly market is the single firm operating in the market, right? Industry. Right? The monopoly. Now we know that we have the monopoly in tobacco, no? Right? There is a government monopoly, right? Tobacco, right? One firm, the tobacco industry. Right? That is the legal, right? There is the strict the market. Right? That is monopoly market. Right? Earlier we had a shale gas, no? And we had a shale gas. Earlier we had a monopoly, right? The agreement with the government that organizes, right? So that's the monopoly market, so they can control the price, right? So the price is varying, right? That situation, right? Price not constant, right? So then if we take the price into quantity, at different prices, different revenues, right? So that means it's becomes the total revenue function. We are talking about the total revenue. So that becomes the non-lead, right? Non-lead, right? The perfectly competitive market, if there is fixed price, right? That is the total revenue curve. Before the total revenue, that is lead, right? So that each price there is a quantity, right? Price is one, right? But in other market structures, it becomes non-lead, right? So the total revenue is the total earnings that we measure for a period of time. Per day, per month, per year, like that, depending on the sale. Right? So we calculate this price into quantity, right? And that is the total revenue, right? So we can say the total revenue of the firms depends on the market condition, right? The market determines the price and the quantity, right? You know the market, right? At according to the demand and supply, price is determined, that is the market clearing price, and the respective quantity also there. So that is the market condition depending on the demand supply variation. Right? We know that sometimes demand may change, supply change, right? It's the different factors, right? So this price and the quantity change. That's why with respect to change in the market conditions, right? The total revenue also change, right? And if we go back to the average revenue, what does it mean average? Now we talk about the average cost, right? Now variable cost, now fixed cost, right? Right? So run, don't run, right? What does it mean average? So that is the per unit, right? Per unit, right? So average revenue that the firm's earnings per unit of total, right? So that is the ratio between the total revenue and the demand, right? If you divide the total revenue by the quantity or the market demand, so that is the average revenue, right? Now we know that total revenue, TR means price into quantity, right? Product of price and the quantity, right? That means E into Q, yes, divided by the Q, right? That is the average revenue. Can cancel out, so that means average revenue equals to price, right? Price of the product, right? Average revenue equals to price of the product, right? That means, for an example, okay, right? So, Total revenue means the price into quantity, right? So the average revenue means PQ divided by Q, that equals to price, right? Right? However, we know that we take the demand function, right? Q equals, right? The 20 minus 5P, right? That is our demand function, right? So that demand depends on the price, right? That's the only product, right? So how you calculate the total revenue? Now this is the, we know that according to the law of demand, right? Demand, quantity demand depends on the price. So this is the direct version, right? Direct function, right? Direct function, right? Now we know that total revenue is price into quantity, right? So there is total revenue also depends on the output, right? Right. Total revenue also depends on all the cost, right? That means the cost functions. Cost also depends on output. Revenue, total revenue also depends on output, right? We calculate the profit. So that also depends on output, right? Right. All the cost, revenue, profit functions, right? Depends on the output. So therefore, remember, right? So when you differentiate, when you make the slope of these curves, right? So we take in terms of output, right? Because this new profit function depends on the output, right? Now here it explains the quantity demand, right? Direct function is the demand, quantity demand, the function of the price of the product, right? Direct function, right? Therefore, we have to convert it to the indirect function, right? We take the in terms of P. So that means 5P equals 20 minus Q. P means 4 minus 0.2. Right? Right. The just I'm not very right. Right. So they say that is the indirect, this is the indirect function. Right. Indirect function, right? Now total revenue is that is also depends on the output. So therefore we have to convert when you measure the total revenue, right? We have given the demand function, no? We need to find the indirect function, right? Price function, right? So this is price function, right? In order to calculate the total revenue, right? So then you can calculate the total revenue function, right? Price into quantity. Price means 4 minus 0.2 Q into quantity, right? So that means total revenue mean equals 4Q minus 0.2 Q square, right? So that is our total revenue function, right? So if we take the average revenue, that is the per unit, so, right? Average revenue, average revenue. Average revenue is the total revenue divided by output, right? So the total revenue function is 4Q minus 0.2 Q square, right? Divided by Q. That is the average revenue, right? 4 minus 0.2 Q, right? That is the, now here you see is the total revenue. This is the total revenue, that is the average revenue. So this is the demand function, right? Direct. This is the direct form, The price equal 4 minus bought issue, right? So the average revenue also 4 minus price equal average revenue. That equals to demand, right? You can see the price that is equals to average revenue, right? So since perfectly replicate and obviously we talk about the competitive market, right? So that is the found area, right? So even today's discussion that is related to the competitive market. Now we know that in a competitive market, there is a market determines the price, right? Price is fixed, right? Price is constant, right? So, that equals to the average revenue and the demand, right? So, that means firms demand curve, right? So that is depending on the price in the market, right? Short term, the market, right? Because market determines the price according to the market forces, right? Firm accept the price, right? Because single firm cannot influence the price, right? So that means single firm's demand curve is, it's the nature of the demand curve is perfectly elastic demand curve, right? Perfectly elastic demand curve. So we discussed that now that equals to the price and the average revenue, right? It's horizontal demand curve, firm's demand curve is horizontal, right? That equals to price equal average revenue, right? Right. So that is the average revenue, right? So per unit, right? Firms are in terms of per unit, so right. So now we take the price equals the average revenue, right? So that vary from depending on the market situation, right? So since the market, some market AR average revenue, right, remain constant, that means the price is constant, right? Because price equal average revenue, right? Competitive market, right? So that also in other markets also we take the same form, right? Price equal average revenue, right? But in the some market the price is fixed, so we can take it average revenue also constant in such market, right? So that is the reason, right? Firm cannot influence, right? Market determine price, then perfectly competitive market. So everything depends on the market price, right? Since the single firm has no control over the price. So such firms we call it as price taker firm, price takers. Why we say price takers? We take the price because we are depends on the market, depending on the market, right? The market forces, broadly, demand and supply forces determine price. Single firm accept, they have to work on the price, right? Because whatever if they increase the price, there is a market price, but firms increase the price. You know, get the more benefits, let's say. Can it happen? Right? If one firm increase the price, what happens? They are losing, right? Because we know that in the competitive market, no? Information, perfect information is there. There are other firms, there are thousands of other firms, right? Operating in the market, right? So the consumer, right? They should do those firms, right? So that means even though it's a single firm increase the price, they cannot maintain that price, right? Yeah, okay, right? That's case, right? So the demand will decrease, right? Because price increase, but demand decrease, so that's production, right? So that means they are for revenue decrease, right? So that's why we say these firms are price takers, right? So it's their price is determined by the market and single firm work on this price, right? Accepting that price, they have to decide how much they are supplying, right? In the market, right? Depending on the price, maybe depending on the right? So that way, price is constant, different quantities, no? Right? That means perfectly elastic demand curve, no? Right? Price is constant, but the firm has the freedom to supply any quantity, no? Right? So the competitive market, no? Right? So quantity, no? The market is there, but there is a possibility to supply any quantity at the given price, no? Right? That means there is a perfectly elastic demand, right? Right? Right. Now this is the situation that now it's price. If the price is fixed, no, right? We know that price is quantity, no, constant. At each price there can be a quantity. Different quantities can be said, no, right? Can be sold by different markets, different curves, no, right? So therefore, the total revenue curve is linear, no, right? When at the different prices there can be different quantities, but the price is fixed, no, right? Price is fixed here. At that point, right? We know that quantity is determined, right? So the firms can sell different quantities, no, right? At the given price. No? So that means price equal average revenue, no, right? So we take the marginal revenue. Second, right? So that in turn equals to the marginal revenue also here, no, right? In this case, right? So the total revenue curve is upward sloping, right? Is the total revenue we calculate price into market, right? If the price is constant, revenue become linear, right? And this is the demand curve for the firm, no, right? So then it becomes perfectly elastic, no, right? Okay. Right. If there are other firms, right, in perfect market situation, what happens? Price varies, no, right? Firm can charge different prices, no, right? So in that case, the demand curve become, total revenue curve become non-linear, right? When it is increasing, right, and up to the maximum, then the demand of total revenue also decrease, right? So that is the behavior at the higher prices, no, right? You know that demand decrease, no, right? So then thereafter, right, there may be decline in the demand for that product, therefore total revenue tends to decrease, no, right? So in the firms, we take the firm's demand curve, right? In such markets, right? The normal demand curve, right? Perfect markets, it's a normal demand curve. The normal demand curve, you know that from left to right. Right? Earlier we saw the demand curve, perfect elastic demand curve, right? The perfectly competitive market. Since the price is fixed, right? But in imperfect market, whatever. Perfect market, we face the downward sloping demand because they can fix the price of the quantity one, no, right? Because the monopoly power, no? Based on the monopoly power, they can control the supply, no? And price is determined by the market proportion, right? By limiting the supply, they can raise the price, no, right? If they fix higher price, no, right, using the monopoly power, demand for that product is determined according to the market demand. Right? So that's why the firm can either control price or the quantity. They cannot control both. Right? If the price is controlled, decided by the monopoly firm, demand for that product depends on the market demand. Right? And by limiting the quantities, even no others be around, by limiting the supply, firm can raise the price. Right? Because once they limit the supply means there will be a rise in the price. So that determined by the market, right? So either price or the quantity can determine. In such situation, what we see at higher prices mean lower demand. Price mean higher demand, right? Demand curve is normal demand, right? That's one. Right? There are also same thing happen. It's price equal average revenue. Right? But marginal revenue is something else. Right? Okay, is it clear? Right now we are talk about these markets, right? So later on we talk about, right? But these things are linked in the markets, no? Right? We take here, right? When we talk about the market revenue, right? Average revenue. So the simple thing is now, for the time being, you can keep in your mind, right? The perfectly competitive market price is determined by the market forces. Firm has to, single firm has to act upon the market determined price. So therefore, single firms, the price determined is always fixed. No? That is the market determined price. So there's a fixed price. But when it comes to other markets, just no, right? That means imperfect markets, so they have some control over the price of the quantity, no, right? In that such cases, what happens? Price is variable, right? Therefore, that's why we see the non-linear purpose. And the demand curve for such firms downward sloping demand. Okay, right. Now, if I say, now this is the first, now we take the this is the, let's say, this is the market, no? Right? Market for a particular product, no? Right? And this is the firm. Now, this is the perfectly competitive market, no? Right? We are talking about, right? With the perfectly competitive market, the demand and supply forces are there, right? You know that, right? Right? So this is the market determined according to the demand and supply process. Market determines the price and the quantities, no? Right? The firms, so there are a large number of firms operating in the market, no? Right? So in the perfectly competitive market, right? So this is the these is the demand curve for a particular firm, right? So that is the demand curve, no? Right? But market is determine the price, no? Because there are a large number of suppliers in the market. Perfectly competitive market. Right? We cannot count, no? Infinite number of buyers and sellers. Right? That's why it becomes perfectly competitive, no? Right? So this consumers demand and the producer supply determine the price, right? So that price is fixed, no? Because for a particular firm. So small firm, right? So there are thousands, millions of firms, no? Right? So depending on the market determined price, the firm can supply either Q1 quantity or the Q2 or Q3, you know, right? Or Q4, no? Right? So this is the demand curve for the particular firm, no? Right? So that is the demand curve for the particular firm. That in turn, as we discussed, that is equals to the average revenue and also the marginal revenue, right? That equals to the average revenue and the marginal revenue. In the previous calculation, if you calculate the marginal revenue, right? So taking the first derivative of the total revenue function, right? You can see that it equals to the price, right? So this is the competitive market, perfectly competitive market situation, right? So the demand curve is perfectly elastic, horizontal, right? But in other market structures, we see the downward sloping demand curve, right? Because they firms has some control over the price of the quantity, right? So now we can talk about the marginal revenue, right? What is marginal revenue? For the marginal cost sector, right? Now in the business economics, we use this marginal analysis, right? Part of the equilibrium, right? Economics, basically we use two analytical tools, right? Basically, right? One is the marginal analysis, other one is the equilibrium analysis. Right? We take this marginal, right? Marginal utility is not right. Both will be explained the consumer behavior, producer's behavior, right? We use the marginal concept, right? We don't talk about how the producers and the consumers allocate their resources optimum manner, right? We take some decisions based on that, right? So the criteria based on the marginal analysis, right? In the consumer behavior, you may remember that we talk about the marginal utility equal price, right? Right? And MUX over MUY equals price ratio, right? At the equilibrium, the consumer. When you explain the consumer equilibrium, right? That's why we know that consumer allocate resources efficiently, right? The bidder of products, no, right? Particular manner, right? In order to maximize the utility, right? And even in the producer's behavior, when we talk about, we use the marginal analysis. Right? Where we use? When we talk about this, one thing is we use the profit maximization, no, right? NP equal MR, right? And also we use the marginal productivity, right? So we explain this. Consumer utility, no, right? When we explain the consumer producer's behavior, right? Marginal productivity between the factors of production equals to the price ratio. No? Factors, right? NPL or NPK equal base rate divided by the interest rate. No? Right? That is the margin. Right? So remember, those are the two fundamental. Fundamental concepts that we use, right? Other one is the equilibrium, right? In economics, we talk about the equilibrium, right? The most fundamental, notable concept that we use, right? We talk about the stable situation, right? Particular time period, right? We talk about the market situation at particular time, market becomes stable, right? Market, the market, foreign exchange market, money market, all the markets, right? When you talk about it, you are starting macroeconomic source, we talk about, right? That we are talking about the general equilibrium. Yeah. Yeah. Most important thing is the particular time all the markets come to the equilibrium and compare with the real sector as well, right? Now you identify the sales sector, market sector, two sectors, right? You explain the behavior of the real and the market sector. And we will talk about that, right? So they are actually we talk about this equilibrium in the real sector and the market sector. Right? And the interaction between the real sector and the market sector as well. And going on, right? The whole economics we talk about this equilibrium, right? Simple, so that about market, no, right? Consumer behavior, talk about equilibrium, right? Stable situation, so that we can use for different analysis, no, right? Equilibrium analysis, compare with other markets, no, right? And the welfare side of the economy, no, as well, no, right? So those are the two fundamental concepts that we use. One is marginal analysis and the equilibrium, right? Right? So now here we come to the another marginal analytical tool, that is the marginal revenue. That's very important, right? Earlier we talked about the marginal cost, right? Now here we talk about the marginal revenue, right? Because those two are very important when we explain the profit maximization condition. Right? And the profit maximization marginal revenue should be equal to the marginal cost. Therefore, we need to identify the marginal revenue also. Right? That is the slope of the total revenue function, right? We know the total revenue price into quantity, right? To differentiate the total revenue function, to get marginal, right? So that is the change in the total revenue due to 1 unit change in the output, right? If the demand increase by 1 unit, what is the impact on the total revenue? Right? That is measured by the marginal revenue. Consequence of total revenue, you change in the demand, right? By 1 unit output, right? So if you say that 1 unit, right? Extra unit, say how much the real impact on the total revenue is given by the marginal revenue, right? So that is delta TR over delta Q. Use the delta terms, right? That is the slope of the curve, right? Now we know the linear total revenue curve, right? And the non-linear total revenue curve in two different marks. Linear total revenue curve, if you measure the slope, what is it? Linear price into quantity, right? Equals to linear curve EQ, right? Linear curve, right? So the slope is constant, right? Is it correct? Slope is constant, right? Because price is constant. Only the quantity can be varied, right? So if you differentiate the total revenue in terms of Q, right? What you get, that is equal to price, right? Right. So marginal revenue equals to price, there. That's why in the linear line, we know that slope is constant, right? That equals to price of the product. Right? So price into quantity. dPQ over dQ, right? To differentiate the total revenue function, that will explain the price of the product, right? So that is delta TR over delta Q, right? Is it correct? Can you understand what I said, right? Right? Can you understand? Right? Yeah, right? For an example, actually we take the differential revenue. The total revenue is the price into quantity, That means the dTR over dQ. To differentiate this function, that what you get? dQ, only the fee, price. Right? To differentiate, right? But we have to now, if there's something else we have to use, right? We'll talk about later, right? But if you take this dTR over dQ, right? If you differentiate this function in terms of Q, right? Because total revenue depends on the output domain, right? Function of output, right? So it will equals to price, right? So that means marginal revenue equals to price, right? And you can see that to use some equation, and if you calculate the marginal revenue, right? You can see it's equals to the price, right? Because now here price is constant, right? Price is constant. That's why we get all the time this marginal revenue is constant. No, that also constant. No, like price, no, like average revenue. That's why the perfectly competitive market we said all these are constant, no, right? Like P equal MR equal AR. No, this is happening only perfectly competitive market, right? The price is constant, right? But MR may take different form in other markets, right? Right. That is the marginal revenue, right? So that in turn, in a perfectly competitive market, if we take, right? So that will equals to the price of the product or average revenue, right? Same thing, right? Now here we are going to talk about that marginal revenue curve when the price is not affected by the firm's output. Marginal revenue curve when the price is not affected by the firm's output. Means price take a firm. Perfectly competitive market. Because price is not affected, no? Right? Price is constant. Such a market. Right? So we know that in such a market situation, the firms face horizontal demand curve, no? Right? Horizontal demand curve, no? Right? Because price is fixed, no? Right? Quantity can be varying, no? Right? Firm can apply any quantity depending on the market price, right? And that will equals the average revenue and the demand curve was the same. Right? And marginal revenue curve when the price varies, right? The price take different forms, right? The price is going to be varied. That means in perfect market situation, what happens? The demand curve. That means either price or the quantity can be controlled by the firm over the demand curve based by the demand. So there are also now the price equals average revenue. That is equals to the demand curve, right? But the marginal revenue is less than that. That will not be equals to the marginal revenue. Price is not equal to the marginal revenue in such a market. Because price vary, right? Total revenue also varies accordingly. So without non-linear function, right? Total revenue is not linear. That means the demand curve is downward sloping, marginal revenue is less than the average revenue. Right? Such a market, right? Okay. So now you can take this table, right? Now here we take the different quantities, no? Q 0, 200, 400, 600, blah blah blah, right? And price equals average revenue equals marginal revenue, right? Because price take a firm, no? Right? Price is, so the firm is work on the market determined price. Market fix the price, fixed price is there, no? So let's find price is 5. So that equals to average revenue market marginal revenue. Right? And if you take the total revenue, you calculate price into quantity, right? So how much is 200 into 5,000, no? Right? So the total revenue curve with respect to this quantities, right? And price into quantity, right? So you can go the what are the two? You can go the total revenue curve, right? What are the two axes? Y axis, X axis. And you know this is Y, this is the X, right? But people take the Y axis, and people take the X axis. Okay, so the total revenue curve. Total revenue depends on the output. Okay. Y axis are people. Only independent variable. Independent variable. X depends on the output. So X axis equal output. we take the linear line, right? Linear line. In this price equal average revenue, right? So we put the total revenue in the y-axis, x-axis, output, right? We draw the curve that will explain the total revenue curve. Right? Become linear, right? Linear, that's why we get the linear curve. The price is constant, that in turn equals to the average revenue and the marginal, right? I have repeated down several times, no? Right? Same thing, right? So in other case, what is this other market, no? Right? They are actually we take now different quantities, like same, right? But different quantities, right? Here what happens? Price is varied, no? Right? At higher, so normally, the higher price, no? Right? Then the quantity increase, no? Right? What happened? Price should decrease. There's inverse relation between the price and the quantity demand, no? Right? Right? So at zero quantity, the price 8, no? Right? And the quantity at price 7, quantity 1, no? Right? Demand, price 6, quantity 2, no? When the price decrease, demand increase, no? Right? So this is the price vary, no? Right? So that we know that price equal average revenue, no? Right? Right? Here also, right? When you estimate the total revenue, price into quantity, no? Right? 6, 12, 15, no? Right? What happened? To plot the total revenue curve in this case, is it linear or non-linear? You can draw the curve and see, no? Right? What happened? Total revenue increase, no? Come to the maximum, then decrease, no? Right? It's like non-linear curve, no? Right? To take the marginal revenue, right? Here also you can calculate the marginal revenue, right? So that's taking total revenue divided by the quantity, no? That will equals to 5 of the cases, no? Right? But here, marginal revenue, delta TR divided by delta Q. What happened? 0 minus 7, sorry, 0 minus 7, 7. If we take this difference, no? Right? 1 divided by 7 divided by 1, no? Right? Here 7, right? And then what happened? 5, 3, 1, no? Like that, no? Right? Negative, no? Right? Finally, marginal revenue curve is also linear, but this is the demand curve, no? Right? So this is the demand, no? Right? You plot the demand curve and see, right? Marginal revenue curve, right? Less than, no? Right? Now, at for an example, marginal revenue positive and it becomes negative, there is a 0 point also, no? Right? This, no? 0 point is there, no? Right? Here it's not reflect, right? So normally, when the total revenue is maximized, no? Right? You know that marginal revenue comes to 0, right? At the maximum point somewhere. I'm guessing here, no? Right? Some points, right? So anyway, so normally the marginal revenue curve is downward sloping, right? There is a positive marginal revenue and the negative marginal revenue. Normally, producer make the positive region, you know, as we discussed the profitable area, no? Right? You can see here also the key of right? So that is the marginal revenue. Here the price vary, no? Right? So the marginal revenue is different from the price, no? Right? Right? So this is the price, no? Right? So price is less than that, always less than that, not equals to the price. Right? Is it clear? We can see if there's fixed price, what happened? If there's variable price, what happened? Fixed price case is the perfectly competitive market. Variable price is imperfect market, right? So there, in the fixed price case, we know that price equal average revenue equals marginal revenue, and the total revenue become linear. But in the perfect market, price vary, right? Total revenue become non-linear, but marginal revenue is different from the average revenue. Right? Right. Why? And that this case, right? We know that normal demand curve, right? The perfect market, right? So demand curve, right? Price, total revenue, marginal revenue, right? Over the things are there. The output, right? This is the demand, E. That equals to average revenue. So this is the marginal revenue curve. Being equally at the middle point, right? Close to the middle point. This is the marginal revenue. More steeper curves, right? This is the demand curves. So, okay, say the marginal revenue is more steeper curve than the demand curve. The more steeper curve than the average revenue. Marginal revenue curve is more steeper. Here we see the arrow very different. Because of what more steeper. Normally it's double steeper than the average revenue, right? Double steeper than the average. So this is the point where the intersect of right? Marginal revenue equals 0. This area marginal revenue positive. Hereafter marginal revenue become negative, right? So in the friends, we know that in the production function we also explain. Producer select positive marginal revenue, the marginal productivity, right? A. Here also producer select positive marginal revenue, not the negative. So if you draw the total revenue curve for this, right? So the total revenue maximize at this point, right? So let the total revenue increase. This is the total revenue curve. And the total revenue maximize, right? The revenue partially, right? We can see more on the data, right? We can decompose it, right? It's the total revenue curve, not only perfect market, right? Like we discussed earlier, right? And also, you know something, you think about demand curve, right? Downwards of demand curve, what you can say regarding the downward sloping demand curve? Any idea? If you write downward sloping demand curve, linear demand curve, what you can say? You think something into your mind? Linear, downward sloping demand regarding the elasticity, price elasticity. Can you remember? Price elasticity vary from 0 to infinity. Can you remember? Linear downward sloping demand curve. At this point, if you calculate the price elasticity, what happens? At this point, what happens? At the middle point, the demand curve. Then remember, it's price elasticity of demand. Elasticity of demand equals 0. Here, price elasticity of demand equals to infinity, right? At the middle point, price elasticity of demand equals to 1 of the demand curve. And remember, right? We know these things, right? The elasticity, right? At the middle point of the demand curve, elasticity of demand equals 0, linear, right? Linear demand, right? That's our linear, right? So in between this, what happened? 1 and the infinite price elasticity of demand greater than what? That means, price elastic of demand greater than what? Right? That means elastic demand. Between this area, price elasticity of demand less than one, inelastic. Right? Right. At the middle point, equals to 1. So now if you consider, if you think about, right, now I'm talking a little bit now, earlier we'll talk about, right? Now this is the positive area, no, right? Here start from here, positive, 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 comes to 0, marginal revenue. In the positive area, if you look at the elasticity is greater than 1. The negative area, elasticity, price elasticity of this product is less than 1 in the last. When the marginal revenue equals 0, at that point we know that total revenue DTR over DQ equals to 0 at this point. No, that means slope equals to 0. At that point, you calculate the elasticity, that means equals to 1. Right? When the total revenue is maximized and the marginal revenue is 0, right? At that point, elasticity equals to 1. Right? Price elasticity of unitary elastic, right? Or unitary, no? Unitary elastic, right? Now we with your discussions, right? Elasticity also here, right? So therefore, we need to refer to these things in consider also, right? Right? To refer because these things are related, no? Right? Right. So that's why we say now normally the rational producer select this positive marginal revenue, right? Where at that point, right, elasticity of this product is greater than 1. So now in the imperfect market, mostly the firms produce elastic region. So that's why they earn profits, no, right? Most of the time. Produce elastic region where we can get positive marginal revenue, right? Greater than 1, right? Right. So showing the things are there, right? So to make your ideas with the elastic, we will take the minutes again, right? At this discussion, right? Is it clear, right? So even though we saw this graph, that's how many things explained, right? Behind the graph, right? That is the important thing, right? So if you will even in the exams, right? You know the graph, right? The scrolling graph is not sufficient, right? You need to explain behind the graph, not behind, like, you know, you see the film, the film soul, right? Now you are not going to film soul, right? And you see the film soul, right? Behind the screen, there are so many things happening, right? You are not thinking about this, you look at the film, right? So many things are there, right? Even if you don't know what the film was, right? You are going to go to the film, right? That right? The thing also there, maybe that is different, no, right? So in now behind this graph, right? So many things are there, right? You need to understand those things and explain those things, right? Very clear, right? Okay. Price is 0. Yes. Because now the total revenue at this point maximize. Now we know this is the imperfect market, no? Price is vary, right? So that means total revenue curve become non-linear. So when the output increase, total revenue also increase. At the higher output level, we know that there's an inverse relationship between the price and the quantity, right? Right. And that can be the higher prices, no, right? At the lower prices, no, right? Higher quantity demand, no, right? No, right? But normally, at when the price vary, right? Total revenue curve become linear, not linear, non-linear, but In the fixed price case, we identify the linear demand curve. So, linear total revenue curve, no? Right? Now here the DTR DQ means that you differentiate the total revenue curve, right? Price into quantity, no, right? There it is. So delta TR over delta Q. At the maximum point, 0 equals slope equals 0, no, right?
The price is zero.
Price is not 0. I didn't say price is 0. You can check the price at this point. You need to touch the demand curve and see the price. Here, price is not 0. Only the slope is 0. Marginal revenue is 0. What's the price? There is a positive price. Price is here. In order to estimate the price, you need once to have the demand curve, right? And at this quantity, you can measure the price. Because you know at the marginal revenue, at which output level marginal revenue equals to 0. You can get the output level. Or in other words, which output level total revenue is maximized. Based on the total revenue curve, you can measure output level which maximizes the total revenue. Right? And that point, at least that is the quantity, you know, here. Right? Right? So based on this quantity, if you know the demand function, right, you can check the price. Right? Price is something here, right? You can measure that price, right? If you know the demand function. And even you can measure the price range. This is the price range where we have these positive elasticities, data elasticities. That is called price range. We will calculate those things, right? You can estimate all these points, right? So that is the requirement, right? You need to estimate the price. This price is quantity. Those are the questions that we have, right? That's why we discuss all this. Even the elasticities you can measure, right? Then you can check at the positive if there's a greater elasticity, what happened to the marginal revenue, what happened to the price. All these things also we can check. First thing, price. Right? Price is not equal 0. Price is something here, right? That explain you need to see the demand curve, right? With the relevant quantity, then you can estimate the price, right? Right. So here the slope is 0, right? Because DTR of D2 equals 0, because at that point we know that total revenue is maximized, right? Right. Okay, so we talk about this table, right? So where we have the fixed prices and the variable price. There are the two cases we have to explain the different market situations we were not for. So in which feature we can identify it to explain the market structures. One market we see the fixed prices, other markets we do variable prices. Accordingly, the demand curve like the firms also change, right? Right. Now, relationship between the price elasticity and the marginal revenue. Right. Now you know the price elasticity. So you need to tell me what you mean by the price elasticity. What do you mean by the price elasticity? Right. Yes. Now we know that elasticity. That's the responsiveness of factors that determine demand with respect to change in the factor of demand. Right. Factors that determine the demand, right? Right. So how the demand is going to be created with respect to the different factors that determine it, right? Because we identify the demand function when we get the different factor, right? Price of related goods, right? Income, right? Price. Different factors we identify, right? So what do you mean by the price elasticity? Yes. Again, price elasticity of demand. So that basically highlight change in demand, it's change in the price, right? It's change in the own price, right? Right. When the price of the product change, right? What kind of impact is there, right? So that measures the relationship between the demand and the price of the own product, right? What kind of relationship exists? Yes, strong relationship or weak relationship. Right? Elastic means strong relationship, right? Inelastic means weak relationship, right? Find the elastic demand and inelastic demand, right? So if there is a high sensitivity between the price and the quantity demand, right? Demand is said to be high elastic, right? If there is a low sensitivity between the price and the quantity demand is low sensitive, inelastic, right? So therefore, basically, we can identify the versions, two versions of elastic demand, inelastic demand. So what happened? Now we know that product can be either elastic or inelastic, right? When you measure the price elasticity, you identify that when the firms decide the price, firms must be very careful about the price elasticity, right? And why? If there is elastic demand, what is the rational decision? If there is inelastic demand, what is the rational decision? And if so, the manager, sales manager has to take. Firms produce the product, that product has elastic demand. So if the sales manager decides to raise the prices of the product with the view to promoting or increasing revenue, can it happen? Yes. What is the rational decision? First of all, now you study the elasticity. So what is the importance of the elasticity? We mentioned that when we are making the pricing decisions, we need to be very careful about the price elasticity, right? If there is elastic demand, what happens? Raising the price, then lose the revenue. Elastic means there is high sensitivity between the price and the quantity demand. If the firm decides to raise the price, that will reduce the quantity demand significantly. Firms may lose the total revenue, right? So in such situations, if there is elastic demand, what happens? Decreasing the price is more beneficial for the firm to maximize the total revenue, right? But in elastic case, raising the price because there is low sensitivity, right? So that's why the government all the time raise the taxes on the goods which are inelastic, right? I mean, moving goods, right? So when the taxes increase, what happens? Price of those goods increase, right? The market, but demand not yet significantly, right? Even though the price will increase, demand will not increase proportionately, right? Because inelastic demand. So the government can achieve the government targets, government revenue increase, right? Even though the price increase, sort of the pricing quantity, the demand, the revenue does not change, right? So the government can earn more revenue, tax revenue for the goods which have the imported taxes for the goods which have inelastic demand, right? So that is the case. Now we have two cases: price elastic, price inelastic. Right? So if there is elastic demand, decrease the price, right? We need to decrease the price, right? Right. So that decrease in the price will lead to proportionately larger increase in the quantity demand. Because there is a high sensitivity between the price and the quantity. Right? So that will increase the revenue, right? And the marginal revenue become positive, right? In that case. So, but in that graph we draw, right? You can see in the elastic region, marginal revenue is positive, right? And if there is inelastic demand, right? It's the other way around, right? Decreasing the price is not beneficial, right? Right. In that case, increasing the price, right? The demand is inelastic, increasing the price will lead to proportionately smaller increase in the sales revenue, right? Right. So the decreasing the price is not beneficial, right? So that will reduce the revenue. Because marginal revenue is negative in that case, right? Yeah. So the graph that we draw, right? Yes, negative marginal revenue, right? That can be highlighted in the inelastic region of the demand. So we can divide the demand from elastic region and the inelastic region, downward sloping demand curve, right? So we see the elastic region, marginal revenue is positive, right? So in that region, what happened? Decrease in the price, right? So that will increase the revenue. In elastic region, what happened? Yes, decrease in the price will boost the revenue. Therefore, increasing the price is beneficial in the elastic region. Right. So this is the one that we draw only, right? We draw separately draw the total revenue curve, right? So this is the demand curve, right? Facing downward sloping demand curve, right? So the linear demand curve, we know that price elasticity of demand varies from 0 to infinity, right? At the middle point of the demand curve, elasticity is equals to what, right? Is the intersection point of the quantity axis, price elasticity demand equals 0, right? At the intersection point of the price axis, right? Price elasticity of demand infinity, in between 0 and 1, elastic demand, in between 0 and 1, price elasticity is elastic, right? At the middle point, so this is the middle point we take, right? That is not the middle point, right? So we know that this is the demand curve, right? So this is the marginal revenue curve, right? Double steeper than the demand curve, right? Lower than the demand curve of the evaluation curve, right? So when the marginal revenue is that is the this is the total revenue curve, right? This case, right? When the total revenue is maximized, marginal revenue equals to 0. At that point, if you calculate the price elasticity of demand, that will be equals to 1 to the elastic. Right? So when the total revenue is maximized, increasing at an increasing rate, right? So that's why the marginal revenue increased, right? And then after a certain point, at this output level, after that, total revenue tends to decrease, right? So that means marginal revenue becomes negative. Yeah. Take this area, if you take the slope, dq over dq is greater than 0, okay? Greater than 1, right? Greater than 1, right? Here equals to 0, here less than 1, right? So that's right, it's negative, right? So that explains its marginal revenue curve, slope of the total revenue curve, right? So our purpose is to now in our analysis, right? So once we identify this nature of this demand, marginal revenue, total revenue curve, right? And we need to estimate the point, the total revenue maximized, right? Where the output level, right? Which output level the total revenue is maximized, right? for which output level marginal revenue equals 0, right? And what is the price? The firm's charge, no, right? When the total revenue is maximized, no, right? So those things we need to take, right? Is it clear, right? Any questions? Okay. And now this is now you can see the mathematical, right? It's simple, right? Like we mentioned, now this is the demand curve, right? Q equal 100 minus 5p, right? So that is our demand curve, right? So that is the direct function, no? As we mentioned, right? So that is our direct function, right? Demand 100 minus 5p. Demand depends on the price of the product, right? Now, in order to measure, right, now we are going to see the relationship between the total revenue, marginal revenue, average revenue, right? What kind of relationship is there? Now, you know the graphical. Earlier we talk about the graphical inverse relationship, by involving the total revenue curve, marginal revenue, average revenue, right? You know graphically how these the situations is going to be explained, no? And you identify the relationship between the total revenue and marginal revenue, right? Graphically, you know, right? Now we see the mathematical details from the equation, right? Now this is our demand function. Q equal 100 minus 5p, right? So that is direct formula, right? So if we need to find out the indirect function, right? That is the price function. So once you convert this one into the price function, right? We can take P equal 20 minus 0.2 Q, right? So then the total revenue you can take. Now we take the total revenue. Total revenue is the price into quantity, right? So we know the price function multiplied by the quantity, right? So then total revenue becomes 20Q minus 0.2Q, yeah, right? Multiplied by Q, right? Price function, right? So then this is the total revenue function, right? So that total revenue function, right? This is the total revenue function, right? Yeah, minus VR VTQ minus 0.2Q. Yeah, right? That is our total revenue function, right? So there is the marginal revenue. In order to get the marginal revenue, we need to differentiate the total revenue function. If you take the first order differentiation, right? So you know that total revenue depends on the output, right? So you differentiate the total revenue function in terms of output, DTR over DQ, right? So that is the marginal revenue. To differentiate this function, Q to power 1, 1 into 2 into 20, Q minus 1 means is the 1 minus 1 means 0, right? That means 20. 2 into 0.24, 0.4. 2 minus 1 means 2 to power 1. Means we can write it, right? So the MR is 20 minus 0.2Q, right? So this is the demand curve, right? Yes, so that's also that. Otherwise, it will be the case in the version, right? But we will go in later, right? So, okay, right? This is the marginal revenue, okay? But majority can see, right? And there is unfair, right? Huh? How it is? There's a which one? This one? You can you do it? I also they can see. And now they can see the whiteboard. Can you see the whiteboard? Those who are online. So can you hear me? Can you see the whiteboard also? Okay, right? So the MR, we can write it 20 minus 0.24 Q, right? Okay. So then, what is that is the MR, no? Right? So if you look at this MR, right? Now our price function, no? Demand function, but the point two is, what is it? Point two here. The price function. What does it explain? 0.2, 0.2. That is the slope. That is the slope of the demand function, right? 0.2 is the slope of the demand function, right? So we know that QD equals A minus BP, right? B means the slope, right? So this is B is by Q equal linear function. You may remember, right? That makes plus C that we convert into Q equal 100 minus 5B. This A means autonomous demand, right? So then this is the slope. B means BP, right? Can you remember? B is the slope of the demand curve. Here the B is 0.6. That is the slope, right? Now here the marginal revenue slope is how much? 0.4. They are 0.2 here, 0.4. That means the demand curve, right? So this is the marginal revenue curve. The demand curve slope is 0.2 minus 0.2. Marginal revenue slope is minus 0.4. Double steeper, twice. Twice slope, right? We compare the demand curve and the marginal revenue, right? So that's why we say the more steeper curve, right? Normally it's twice as steeper than the demand curve. So the marginal revenue curve slope is twice as steeper than the demand curve, right? So if you draw the graphically, right? Normally, so that's why I mentioned the cuts, equating the balance in the two, that x-axis, output axis at the middle point, right? Right. And it's twice as steeper than the demand curve, right? So this is the marginal revenue, 20 to 0.4 Q. Right? So the average revenue, that means TR divided by Q. So we know the total revenue, right? We divide by Q, that will be the average revenue, 20 minus 0.2 Q, right? So that in turn equals to the price for the demand curve, right? So this is the demand curve, right? The right, right? So the demand curve is the price function, we write it 20 minus 0.2 Q. For the marginal revenue curve, right? This is the marginal revenue curve, right? That equals to twice as steeper than the demand curve, right? So marginal revenue 20. So is twice as steep, right? So this actually you would draw this line, right? Goes to the middle point, right? Right. So the average revenue equal marginal revenue equals price and the D demand curve also, right? That's right. Now We have the total revenue for right. 20Q minus Y2 into the marginal revenue, that means you obtain DTR over DQ, right? That is marginal revenue, right? For 20 minus 0.4Q. Now, we need to find out this point, right? Right? Can you find out what this point? Demand. So you know the total revenue, right? So they don't find out that what we have to do. But at the maximum point, it becomes the total revenue is maximized, right? So that means we need to equate this term function to 0, right? In 20 minus 0.4Q equals 0, right? We need to find out output level, right? So you can tell me what is the answer. Minus 20 Q how much? 20 divided by 0.4 by 58. Right? So this is 50 output level. Right? Output level is 50, right? Then what you can measure, right? So then you can measure when the output level 50, right? You can measure the total revenue, right? How much is the total revenue? Substitute to the total revenue part, right? Yeah. And the price chart. How much is the price? We have the price function, no, right? Equals the price function we did at 20 minus 0.250. Substitute this one, right? It will be 50. Price is how much? 0.2 into 50. 0.2 into 50. Right. 10, right? Correct? 10, right? So writing 10. This price is 10, right? I think you can see, right? Those who online, they also can see, right? This price is 10. Then we have something, right? Now this price, right? And also we need to know the elasticity. We know this elasticity is greater than 1, right? Right. That this elasticity less than 1 in elasticity, right? So this price, that is the price range, right? We can calculate this price range also. In the price range, we calculate one price, but in this price, that means when the quantity equals 0, how much is the price, right? The quantity equals 0, right? How much is the price? So that means price equal 20. Okay, right. Right? The price is 20. Can check, right? Whether it's correct. I don't write, but I am writing here, right? You can do it your own, right? Make your calculations and if you like exercise, you can narrated, right? So that is the price range. So we can calculate the price range. Why this is price range is very important, right? So this price range, we know that elasticity is greater than 1, right? So the producer maximize output, maximize revenue, right? So that means this is the profit maximization also, right? That is price range, right? Any price you can decide, right? Total revenue maximized in this price range. This is the total revenue maximum price range. There is the profit maximization later on, right? Okay, right? I think it's clear, right? Now, what is this? Now here we use now total so that price into quantity, right? There is something called the product rule you may hear. Okay. Product rule. Product rule. So total revenue is the product of price and the quantity, right? Right? We need to apply the product rule and we differentiate the total revenue part, right? We have the product price into quantity. Right? That's the total revenue. Right? What is the product rule? According to the differentiation, so we take the first variable and we differentiate the second variable, right? And we take the second variable and we differentiate the first variable. First we take the price, right? That means we are going to take the slope of this curve, right? Based on the product rule, right? We are going to calculate the slope, right? Of this total revenue function based on the product rule, right? So that is the n mark, not DT. Here the double TR over double Q because we have two variables, right? Double TR over double Q. That equals to the n mark, right? Marginal revenue, right? So first we take the that means the double PQ over double Q, right? Right. So there we see the product is there, right? So we take the first price, right? And we differentiate the quantity in terms of Q, right? So that means double Q over double Q, right? We take the first variable, we differentiate quantity in terms of quantity, right? So that means double Q over double Q. Here the product will apply the plus here, right? And we take the second variable Q, and differentiate the price in terms of output, double Q over double, right? And we have the double Q over double Q, that means we take the MR price, can take the 1, that is equals to 1, no cancel out. So we can cut each other, right? Now, this we can write Q delta P divided by P delta Q. Right. It is clear that point. How we derive the third line. Third one. Right now we can write it and MR equal P. Q means 1 is something related with the elasticity, Q over P, delta P over delta. We can rewrite it price of 1 minus 1 over PTV prices. Right? P means the profit maximizing price, right? So this is the MR, right? So at the profit maximizing point, we know that MC equal MR. Therefore, instead of MR, we can write it MC also. Right? And replace MR, we can put it MC. MC equal P into 1 minus 1 over price elasticity. That also, right? So that is the the profit maximizing level. Right. 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 Right now the total revenue price into quantity, right? The revenue, right? We like it, we take the price. We take the price about Q over about Q. Plus we take the quantity. We differentiate the price, right? Double Q over double Q. That means marginal revenue equals E into 1 plus Q. Double Q over double Q. Right? What is the next step? We write that part, marginal revenue. We take the price as common way, right? We need to open the bracket, right? Here the one, right? Plus Q over P. Above P over above. The bracket is to see that, right? Right in there, no, right? So that now what you can see here. What? Any idea? You see that one? Thing came into your mind when you see that equation. Scholarship programs are there, and then you have to that part. That's fine. That way, like something you can see there. See that the part what we can see. What you see here. There is something delta Q over delta P into P over Q or delta Q over delta P over Q something. Then like same thing, right? What is it? Now here double P over double Q. Double Q over double P. Delta Q over delta the same thing. Right? But the other way around, right? Q over P. P over Q, right? So this is the price elasticity, right? Price elasticity of demand, how we calculate? Double Q over double P. So dQ over dP into P over Q, right? So this is the, you can write it, demand equal P 1 plus 1 over PE, price elasticity of demand, right? The reciprocal of the price elasticity, right? Yeah. Now, instead of demand, you can write it MC here, right? MC also equal price 1 plus PE, right? Now, the price elasticity of demand is always negative, no? To calculate the price elasticity of demand, it is negative, right? Because there is an inverse relationship between the price and the demand. This becomes negative, right? So that means finally plus minus is also become, can write it, right? MT equals P 1 plus 1 or 1 minus, right? One minus the price elasticity of demand, right? PB, right? That is 1 minus, right? So you can take the price. That is the optimum price. So you take, this is the profit maximizing condition. No? MC equal MR is the profit maximizing condition, right? MC equal MR. Is the profit maximizing condition. MC equal MR. At the profit maximizing, because MC equal MR is the price, right? So we can write in terms of price. Price equal, how can I write? Marginal cost divided by 1 minus 1 over E. Right? 1 minus 1 over E. Right? Price elasticity. Right? Right? Marginal cost or marginal revenue divided by 1 minus 1 over price elasticity. Right? Right, now you can check. Can you remember we draw the curve there? I don't know whether you can. So this one is the demand curve, that means average revenue. This is the marginal revenue, right? At this point, you know that price elasticity curve equals to 1, right? Right. Now you can check if the price elasticity of demand, this one equals to 1. What happened? Let's say right, P equal 1 divided by 1. 1 minus 1 divided by 1, this becomes 0. Okay. Okay. MR equal P. MR also becomes 0. This is the point, right? MR 0. The price elasticity equals to 1. If it is 2, it is greater than 1. Now say the price elasticity is 2. Elastic region, not right? If it is 2, what happens? If you substitute 2, 1 divided by 2, half. 1 minus half, right? That becomes half. Right? 0.5, right? Marginal revenue is positive. Marginal revenue is positive. If it is something inelastic, B is let's say minus 2. Inelastic. What happened? This is 2. Less than, right? Sorry. 0.5. Elastic. 0.5 less than 1. If it is 0.5, 1 over 0.5, right? That means 1 minus 2 means minus 2. 1 minus 1. Minus P. Okay. So that means price elasticity MR becomes negative. Right? Like we can substitute as C, right? Right. So that we can take here, right? Relationship, right? So this explains the relationship in the equation, right? Marginal revenue equal price 1 plus 1 over price elasticity of it. Right? So we can see the relationship between the marginal revenue and the price elasticity. Right. Okay. Any questions? Is it clear? Right. Yes, you can now use the order. You know this one, you can derive this one, right? Only to keep in your mind, right? And check those things, right? Concepts should be there, right? Because it is that the graph we draw, no, right? The relationship, no, right? You can check all these things, no, right? Difficult, right? Difficult, right? Keep in your mind those things, right? Basic concepts, right? Right. So that is the now we derive this one equation, right? Right. Right. You know this one, right? That also, right? All these functions, right? You can manipulation those prices and the quantities, right? We do exercise later, right? And I have uploaded the one tutorial also, right? The midnight yesterday, right? For you to do it right yourself, right? From the previous version of our discussion, right? Production function, right? You can do some of these questions, right? I have given, right? So as a tutorial one is there. They are like from the cost function also I will give some tutorial. Right? With your group also you can discuss it, right? And together, right? If there are any questions, you can ask me, right? There is a difficult something, right? Okay. Right. So that is one, right? So we will stop for a break, right? 15 minutes, right? Please count 15 minutes. Any questions? Is it clear? This one, no? One day. It is always basic to you, right? Right. Okay, you can take a break, right? After this, right? Objections from this side, then yeah, that's very complicated, right? But you must keep in your mind the concept. On the concept, right, you can do it. The same thing I see as E. Right? You cannot see that. That is PET. Normally, like same thing that he means same price as us. Yes, now something I added to the PPT. I will update the Galle. The past here. This program past paper, last year, past paper. Everything. There may be difference, right? From the previous months, but I want to take it those proposals. Now I will give you some tutorial. We have uploaded one tutorial. You can do it and you can. But the question may be different from that from previous version. Because last time. I don't have past year. Right, so right, so we identify the relationship between the marginal revenue and the price elasticity, right? And where we can identify the by rearranging that version, right? The equation that we derive, the marginal revenue equals the price into 1 - 1 more price elasticity, right? We can express the price in terms of price, right? So that will explain the optimum price, right? And the profit maximization level, right? So price means the P, here the P means the optimum price. Charge, right? When the total revenue is maximized, or at the profit maximizing level as well, right? So keep in your mind, this price is the optimum price, right? Now there's a small question, right? So now first question, that is the question asked the optimum price, right? So now you have given the ABC company, observe that 2% increase in the monthly sales, right? It will result in 1% reduction in of goods, right? Price reduction, right? So 2% increase in the monthly sales, right? Will be resulted in 1% price reduction, right? So the marginal cost is $25, right? And calculate the optimum price. So what we have to use is we need to apply the function, right? So we derive the function, right? So the optimum price, so how we calculate, right? So that is the price equals, what is the function? Price equal marginal cost divided by the 1 - 1/8, right? So that is our optimum price factor, right? marginal it's the marginal cost, the optimum price. Optimum price means the marginal cost divided by the marginal cost divided by equals marginal cost divided by 1 minus 1 over, right? E means the price elasticity of demand, right? Price elasticity of demand, right? So we know the marginal cost is given $25, right? So then you must know now there is information given the price elasticity. How we calculate the price elasticity? AED or the E, how we calculate it? Price elasticity. Percentage change in demand divided by the percentage change in price. Right? Percentage change in demand divided by the percentage change in price. Right? Price elasticity demand. Right? So here the percentage change in demand is 2%, right? With respect to change, percentage change in the price is 1%, right? So price elasticity of demand is 2, right? Then we know the price elasticity of demand that's negative, right? Always negative, right? So we can substitute to this equation, right? Marginal cost is given, right? Marginal cost is 25 divided by 1 minus 1 over 2, right? Right. So that's how much? $58, right? So the optimum price is 50, right? So that is the one, right? So if you know this equation, you can, that is marginal revenue, right, into 1 minus 1 over 8, right? So that is our equation, right? So by rearranging that equation, you can identify the price function, price into price, right? So that will be the optimum price, right? Okay, right? Then we move to the profit, right? So it's a longer one, right? So later on at the market, when we talk about the market, we talk on more on this, right? Profit maximizing and all these marginal cost, marginal revenue curves, right? We will discuss, right? Further, right? So the profit, how we calculate the profit? Simply, it is the revenue minus cost, right? Profit is the revenue minus cost. So now we know the total revenue, total cost, right? So all the functions we observe, right? So the behaviors we observe, right? So we know the behavior of the total revenue and the total cost, right? We have some little bit understanding about those cost curves, revenue curves in the different market structures as well, right? So now with that now initially we can identify the profit, right? So the profit is the revenue minus cost, right? Total revenue minus cost. We know that both this cost and the revenue, right? So profit that is also depends on output, right? Total revenue minus total cost, right? All these things are depends on the output, right? Phi is the profit, right? So we can use phi term, right? So that is the profit, right? TR minus TC, right? So now we know we have some understanding about the accounting profit and the economic profit, right? We talk about the economic cost and the accounting cost, right? Can you remember, right? So when we ascertain the cost, according to the accountant's point of view, we take the actuals, no, right? Actual cost. But when we come to the economic cost, no, right? We take the implicit plus explicit cost, no, right? Implicit means the opportunity cost, no, right? So that means we take the real cost, no, right? So that means economic cost means the real cost, right? So here the profit that we calculate. When it comes to the cost, revenue, the total revenue, cost means total cost, no, right? Including implicit cost, no, right? So that's the real cost, no, right? Cost means the real cost, no, right? So that includes explicit and implicit cost, no, right? So we know that in any decisions we can take the opportunity cost, no, right? In both, no, right? So that all these relevant cost we need to consider, no, right? When we take into account implicit cost, right? So that means economic profits means revenue minus explicit plus implicit cost, no, right? So that means the real cost. Revenue minus real cost, right? Now we have given a small example here, right? When you do it quickly, a person who has been working for the salary, right? Of rupees 20,000 a month, start a business, no, right? So if he works in somewhere else, right? He can earn, right? 25,000 salary, right? A month, right? He start a small business, right? Using his own house, right? So that can be given out of rent or 15,000 a month, no, right? The cost of the factor inputs, no, or material after, right? 175,000, and the sales income for the month is 200,000. Calculate the accounting cost and the economic profit. Accounting profit and the economic profit. How we calculate? Can you do it? Do it. Accounting means we take that no? So the prices no high. Financial accounting, legal accounts, something like that, right? So accounting cost and the economic cost, right? We have to ascertain there, right? So how much? Now, if we calculate the accounting cost, so we take the sales revenue, no, right? Sales revenue is how much? 200,000 minus the factor cost, no, right? Right? We deduct the payment for the factors of production, no, right? That means that we include or into your calculations the cost of sales, no, right? Right? Cost of sales, no, right? 200,000 minus 175,000, no, right? So that is the actual base, no, right? So according to the accounting profit, it will be 25,000, no, right? And if you go back to the economic profit, we have to take actual, sorry, 200,000 minus the cost of sales 175,000, right? That is the counting. Right? Then you deduct other expenses, right? That means the implicit cost, we have to deduct it, no, right? Implicit cost increase, that means now include opportunity cost, no, right? That by starting this business, right? If he works somewhere else, he can earn 20,000, right? That is the complete cost of starting this business, right? Salary forgoes, right? And the rent forgoes, right? Because if we rent out for some other people outside, we can earn 15,000 a month, right? Right. So we have the monthly sales and the monthly expenditure given, right? So we prepare for the month, right, with the profits, right? So the 25,000 minus is the implicit cost, right? Foregone rent and the foregone what is salary, right? How much is it? That is 35,000, right? So there will be, there is no profit, there is a loss, right? Loss is how much? 10,000, right? That means we have to take the opportunity cost plus, so that is the implicit cost, right? Plus explicit cost also, right? With including the explicit and the implicit cost, we have to, right? Okay. Then you can, right? Right, okay. So determining the loss. There is a loss, not the profit. Non profit is there, right? 25,000, but economic loss. Yeah, right. 10,000, right? Right. So that is the profit, right? So this is the profit that we talk about, right? That is the difference between the total revenue and the cost, right? Total cost, right? So then we talk about this profit maximization, right? Okay, well, now the profit maximization, now we always, that terms always, or we underline objective we talk about, profit maximization. We have the profit motive organized, right? Even though the firms have other objectives, right? But the profit maximization is there, right? In the theory that we talk about, we take the profit maximization principle, right? So always the firms try to maximize the profits, right? That is one cost, right? And in order to explain, now we are going to explain the profit maximization, right? Now we have the two approaches, right? One is called total approach, other one is called marginal approach, right? So it is not difficult, it's a complex task, right? Here the total approach means we take into account total cost curve and the total revenue curve, right? And then we explain the profit maximization. Marginal approach goes, that means we take into account marginal cost and the marginal revenue, right? The total approach, right? Total approach, we take the profit as TR minus TC, right? So we know that profit or revenue function, right? So revenue is the price of quantity, right? Right. The total cost means we know that we study the cost functions, right? Fixed cost, variable percentage of and then the lower cost situations and so on, right? Right. So that is the payment for the factors of production, right? These things, right? Or cost, right? So now this total approach basically we take into account total revenue and the total cost, right? So that also depends on output, total cost, right? And the marginal approach, marginal. So there are two conditions, right? Two conditions are there in order to confirm the profit maximization. One is called marginal cost equal marginal revenue, right? So here we use the marginal cost and the marginal revenue, the marginal approach, right? In order to explain the profit maximization, right? And the second first condition is marginal cost should equal marginal revenue. And the second condition is marginal cost should be greater than marginal revenue. Beyond that point, right? Beyond the profit maximization point. In order to maximize the profit, right? These two conditions should be satisfied. One is the marginal cost should be equal marginal revenue. Other one is marginal cost should be greater than marginal revenue beyond that point, right? Profit maximization, right? In order to be the maximum profit, right? Marginal cost should be greater than marginal revenue, right? So those are the two approaches, right? Now, first approach we use, if we use the graphical explanation, right? We assume the competitive market, right? We know that total revenue curve is upward sloping, no? Right? Price is fixed, total revenue curve is upward. Now the total cost curve, you know that it's inverse S shape, no? Right? Total cost curve, no? Right? And remember, so the total cost inverse S, no? Right? Like this, no? Right? So now the profit maximization point means where the gap between the total revenue and the total cost is maximized, no? According to this graphical explanation, no? Right? Now, initially we have the loss, no? Because the cost is higher than the revenue. Therefore, we have the loss. Right? This is the profit function, right? Based on this, right? This is the profit function, right? So initially we have the loss, no? From 0 to Q1 level, right? Right. So that means we have loss making, no? Right? So here negative profits, no? Right? Because total cost is higher than the total revenue, right? Here loss is maximized at this point somewhere here, right? Difference rate, right? And this is for break even, no? Right? Break even point means when total cost is equal to total revenue, no? Right? So there is no profit, zero profit, no? Right? At this point, so, right? Break even point. So that means there is zero profit, no? Right? So this is the profit function, right? Difference between the total cost and the total revenue, right? So this explains the profit function, right? At Q1 level, there is a zero profit because total cost equals total revenue, right? So that's what this is the intersection point, right? Zero profit. Then what happens beyond this Q1 output level? Total cost is minimum, no, but the total revenue is higher than the total cost. So there is a profit, no, right, in this region. Q1 to Q3, right? So there is a profit, no, right? So at this point, the profit is maximized when this total revenue curve and the slope of the slope of this total cost curve is over an angle line, no, right? Right. So the gap is wide, no, at this point, right? So that means at this point, total profit is maximized, no, right? So if you draw the line here, right? The one point, these two lines are parallel to each other, no, right? So that is the maximum point, no? Profit maximizing point, right? At this point, right? So the total profit is maximized at this point, that means Q2 level, right? So then somewhat profit decrease, right? Because the cost increase, because the marginal revenue somewhere that higher than that point. So profit is decreased. Again, you come to the break-even point, right? There can be multiple several break-even points, right? Where total cost equal total revenue, right? So at the Q3 level, again, break-even point. So after that, again, the loss, no, right? Like that way, right? We take this only this part, no, right? So here the profit is maximized at this point, right? At the Q2 level, right? So that is the gap between the total revenue and the total cost is maximized, right? So we look at under the total approach, right? So this the profit function, no, right? So we take into account the total profit, right? So this is the profit function, right? So we can ascertain the profit maximizing output level, right? And also we can also look at by analyzing the total cost and the total revenue curves, right? So under total approach, we look at the behavior of the total cost and the total revenue curves, right? And then from that, we are going to measure the total Right. Now, according to the marginal approach, as I mentioned, one condition, other one, there are two conditions. The most important condition is the marginal cost equal marginal revenue, and there should be a second condition also. Marginal cost is higher than the marginal revenue. Okay. Right. Now we have given an example here, right? Okay. Now we have given the total demand function and the total cost function, right? Okay, we can look at this one also, right? Okay, this is based on the total. Okay, we look at this one, right? Marginal, right? So this is the marginal approach, right? Now we know the marginal cost curve, right? So the short run, the average cost and the marginal cost is U-shaped, right? So since there's a diminishing marginal returns to the variation factor proportion, right? So that explains that we are going to increase the output at a given level of capacity, right? At a given level of fixed output, right? Fixed cost, right? So we know that U-shaped curve, right? So this is the average cost curve, right? Short run, right? And the marginal cost curve goes through the minimum point of the average cost curve, right? And this is the marginal revenue curve that will equals to average revenue, that will equals to price. The perfectly competitive market. This reflects the perfectly competitive, right? If you follow the conditions, right? First condition is marginal cost should be equals to marginal revenue, right? Now this is the marginal revenue curve, red line. This is the marginal cost curve, right? Now we find here marginal cost equal marginal revenue at the Q1 output level, right? And another point we find at Q2 output level, right? Marginal cost equal marginal revenue, right? So this is the marginal revenue, this is the marginal cost. At that point, that is the intersection point, right? Marginal cost equal marginal revenue, right? So, but we need to find out the profit maximizing point, whether it's Q1 or Q2, right? So at the Q1 and the Q2 level, first condition is satisfied, but second condition is not satisfied at the Q1 level, right? Because what is the second condition? Marginal cost should be greater than marginal revenue, beyond that approach. So at the Q1 level, if it is to be a maximizing point, right? Marginal cost should be equals to marginal revenue, that is okay, right? But beyond that point being, beyond the Q1 level, marginal revenue is higher than the marginal cost. So this is the marginal revenue curve. This is the marginal cost curve. Marginal cost is lower than the marginal revenue, right? Therefore, second condition is not satisfied, right? So therefore, the Q1 is not the profit maximizing output level. And another reason is this one is compared to the Q2. Q1 is the lower output level, right? So there is a possibility to increase the output further, right? Right. Therefore, Q1 is not the profit maximizing output level, right? If you take the Q2, marginal cost equal marginal revenue, first condition satisfied. And the second condition also satisfied. Here, beyond that point, even the marginal cost curve is higher than the marginal revenue curve, right? Marginal cost is higher than the marginal revenue. Therefore, at the Q2 level, both MC equal MR and the second condition also satisfied. So therefore, Q2 output level is the profit maximizing output level, right? Okay. Right. So that is the marginal approach. There we basically consider marginal cost and the revenue, right? Based on that, we are trying to identify the profit maximizing output level, right? And you also can ascertain the maximum profit there, right? Okay, right. Now we have given this example, right? But here it's given total cost and the total revenue. You can follow the total approach, right? Because we have given the total cost, even you can move to the other approach also, right? You can take the marginal cost, marginal revenue cost as well, right? But you can calculate this one based on the total cost and the total level. What is the profit maximizing output level? Profit maximizing price, maximum profit. Right? Now the Q output level is how much? I think write it here, right? So keep in your mind, right? The demand function is 8.5 minus 0.05 right? Total cost is given 100 minus 38 Q, right? Right. Now, what is the profit maximizing output level? Profit maximizing price and the maximum profit. Okay, can you now you don't find out the profit maximizing output level, right? So we need to find the according to total approach profit function, right? Now we have given the demand function, right? So you need to find the revenue, total revenue, right? You know how to get the total revenue function based on the demand function. So this is the direct function. You need to find out the indirect function, price function, no, right? Then you can obtain the total revenue function. And you know the total cost function, right? So profit is the difference between the total cost and the total revenue, right? Then you can find out the profit function, right? So the profit maximizing means take the first derivative, no, right, of the profit function, no, right? Then you can find out the output level which maximizes the profit based on the profit function. Okay. Can you do it quickly? So we have given the output Q equals 8.5 minus 0.05 Q P, no, right? What is the profit function? Sorry, demand function, inverse demand function, price function, and maybe 0.05 P. How much? The price function. 170. 50. Q. Okay, you got it? Others? Right? Then we'll write it here, right? And then 70 minus 20 Q. Is it correct? 170. Yes, right now. Then the total revenue 170 Q minus 20 Q square marginal revenue. So we have the profit. Profit means 170 Q minus 20 Q square minus 100 plus 38 Q. So the profit function you can take 170 minus 208 of 208 Q minus 20 Q square minus 100. Profit is maximized when you can take the d5 over dq. Right. You don't find out the maximum profit. You differentiate the total profit function. So this is the profit function, right? To differentiate this one, you can find the marginal profit, right? So that means 208 minus 40 Q, right? So in order to be the maximum, right, you need to equate the marginal profit function to 0, no, right? Equals to 0, right? So that means 208 minus 40Q equals 0. So 40Q equals 208. You need how much? $5.2, right? Approximately, you can take 5, right? You take approximate, right? Approximately, you can take 5. Output level is 5. And that is the profit maximizing output level, right? So the maximum profit, how you take? You can substitute 5 into profit function, no? You can find the maximum profit, right? Substitute the profit maximizing output level into profit function, right? Our profit function is 208 minus 20Q square minus 100. You can find the maximum profit from there, right? And the price level, at the profit maximizing output level, you need to substitute to the price function, right? 20 into 500, price is 50, right? 70, right? Price is 7, right? We can find the profit maximizing output level and the maximum profit and the profit maximizing price level at right? Okay. Right. Can I go to the other? Sorry. Here, this is the TR profit is TR minus GP, no? Then minus that converting into the plus. No? Profit is right. Okay. So we'll move to the other one, right? You can find out this substitute, the method of substituting to the equation, right? You can find out the price and the maximum profit as well, right? Okay, right. So then this is example 2, right? So we have given another function, right? Profit function is given. Total profit function is given, right? So how we calculate the marginal profit? Now there are actually product 1 and the 2 products is there, no, right? Now the output, the profit function explains Q1 and the Q2, no, right? So that means this firm produce 2 products, no, right? Not a single product, no, right? This firm produce 2 products, no, right? So the total profit function is given with reference to two products, Q1 and the Q2. Right? Q1 is the product 1, Q2 is the product 2, right? This particular firm produces two products, right? Now we have to, but when we talk the marginal profit function, we need to take it for particular product, right? Right. In terms of product 1 and the product 2, right? We need to derive the marginal profit functions. Okay. And but we can measure the profit maximizing output, right? So based on the covering the two products, right? So that is the profit maximizing level. Right? Collaboratively, Q1 and the Q2, right? Okay. We have given the profit partner, right? 5. 5 is the profit, right? Profit function, Q1 is the product, another product is the Q2, right? Multiple products, right? Multiply, right? Multiply, right? 5 is the 550 Q1. Multiply the profit function, Q1 square plus 100 Q2 minus 4Q square, right? The Q1 and the Q2 are the two products produced by this person, right? So what is the marginal profit function? So how we calculate the marginal profit function in terms of Q1 and then in terms of Q2, right? So the marginal profit function so that we have the number 5. We have the two products, number 5 over number Q1. Marginal profit, right? So this is the marginal profit function for the product 1, right? Q1. Right? If you differentiate the profit function in terms of Q1, what is the answer we got here? We have the 50Q, 50 minus 2Q. The one is Q2, right? So this is the marginal profit function of Q1 and the Q2. So the marginal profit function adding 100 minus 8Q, right? Right? Now, in order to find the maximize the profit, you need to equate these things. The 0, right? So that means lambda 5 over lambda Q1 equals to 0, right? That means 15 minus 2Q equals 0, right? How much is the Q? 20, right? The lambda Q over lambda Q2 equals to 0, right? So that means 100 minus 8Q equals to 0, right? How much is Q? That is clear, no? Point 5 means take here, right? Approximately, we can take the output is clear, right? Then you can take here Q1, Q2, right? So in order to confirm this is the maximum profit, this is the maximum, right? Because this we take the marginal profit function, so you can take the second derivative of this. Kappa Q divided by kappa Q square. That means this, if you differentiate again this function, what is it? That becomes minus 2. Right. Then if you take this one, kappa Q kappa Q square, that becomes minus 8, no? Right? Minus 8. Second derivative, right? Is the maximum, no? Right? Maximum, right? Minus. Second derivative is minus, no? Right? So that means the maximum, right? So these are the maximum output level, right? 25 at the 3. Right? So by substituting this one to the profit function, you can identify the maximum profit, right? Output is the ascertain that the profit maximizing output level Q1 is 25, Q2 approximately 12, right? So even you get up to 12.5 in order to find the maximum profit. You can substitute the total profit function, right? We have given 50 Q1 minus Q1 square, right? Q1 means 25, Q1 square means 25 square, right? Like that, right? You can find the maximum profit. Okay. Okay, right. You have another lecture? I think it's okay. So then we can do this one also, right? We can write this one, right? Okay. So we have given another function, right? Demand and the cost function is given, right? Same way that we earlier we talked about, right? So what we need to find the marginal cost, marginal revenue function, right? And the profit maximizing output level, right? By equating the marginal cost into marginal revenue, right? Can take the profit maximizing output and the price. Can first identify the profit maximizing output by equating the marginal cost and the marginal revenue, right? And the price can not find out the price, right? We have the price function here, right? We can substitute the price function and find the price, the profit maximum level. We don't find out the maximum profit, you need to derive the profit function, right? Based on the TR minus TC, right? And you need to confirm whether that profit is maximum, taking the secondary, right? So that is the question homework, right? You can do it, but there are some other, I think we'll discuss this one, right? Some other questions are also given, right? For you to read it, right? It's available, like anyway, I will upload this one to the LMS. Some of the PPT I changed, right? So I include some changes, right? I will upload that. Okay. So with that, we will write this one back. So next day we will start with the markup structures. Okay. And remember, there 20 seconds, there will be an MCQ test, right? Half an hour, right? Test, right? Okay. Class 2. Open book, right? You can take it, right? Thank you very much.